Hey dividend investors, today I'm going to talk to you about what to invest in a margin or a cash account. Now, let's just get down to it. There's so many different accounts that you can open here in Canada. There's a TFSA, tax-free savings account. There's an RRSP, which is a registered retirement savings account. And then there is a margin and a cash account. Which one's going to be best for you? It's hard to say without knowing what you're going to be investing in and how much money you make and things like that. So really quickly, a TFSA is a tax-free savings account. Depending on your age, you can put a little bit of money into it every single year. So generally around $5,500 a year. However, if you're over the age of 18, you can put more money in than somebody who is under the age of 18. Generally $5,500 a year. However, if you were over the age of 18 at a certain time, I think around 10 years ago, then you can put a little bit more money into it. Basically, it's $5,500 a year, and then some years it was a little bit more. It's a long story, but look into a TFSA if you wanted to make some tax-free gains. An RRSP is another option where if you, let's say, put $1,000 into your RRSP, then you basically have $1,000 less of income when it comes to tax season, and there's a lot of information that you can put in about that as well, but that's a totally different video. Today we're talking about margin and, of course, cash accounts, the differences between them and what you would invest in. So in a cash account, you put your money in, you invest your money, and of course, then you can make money or lose money. And then a margin account, same thing. However, you have whatever stocks are in there, you can actually essentially get a loan to invest in more stocks. And it all comes down to how many stocks and how much equity you have in there versus how much cash, and it's a long story, but what do you want to invest in? So really quickly, if you're going to be investing in dividend stocks, definitely do a TFSA first. Forget about margin and cash, go straight to TFSA. That's going to give you, let's say you're at the age where you can put in around $72,000 or $75,000, I think it is this year, into that account, and you can make 5% off of that, then that would be tax-free. However, if you have it in a cash or margin account and you make, let's say, 5% would be in the range of $3,500, you made that $3,500 in dividend money, then you would be taxed on that money that you made in dividends, that $3,500. Now, when it comes to taxes in Canada for dividends, it's considered not income, so it's you only 50% of your dividends get taxed, and then you're taxed at a different rate than your regular income. So that aside, why not go into a TFSA first, make your $3,500 a year tax-free, and then any money over that limit that you're allowed to put into it, that's when you start going over to a margin account. However, in the margin account, you can deduct from your taxes if, let's say, you had a loss. So in a TFSA or an RRSP, if you lost $5,000 on a stock trade, you can't write that off. However, in a margin or cash account, you can, which is great. So if you made $5,000 on the stock market on a margin account or cash account, and then you go and actually lose $5,000, they negate each other, you don't pay any taxes. But if that was to happen in a TFSA or an RRSP, you lose that $5,000, you're now essentially losing $5,000 of what you can put into that account. So that's the sucky part about the TFSA and RRSP. You want to do safe investments, ETFs, long-term banks, blue chip stocks that are long-term, you would stick into a TFSA. Any money that's over the amount that you cannot put into a TFSA or an RRSP, that's when you would put into a margin account. And you can still do safe investments there, but a margin account, you can go a little bit more riskier. You can say, well, I want to invest in 10 shares of Tesla. If Tesla goes down and I don't feel comfortable holding it anymore, I can sell it, get my money back, but obviously whatever you've lost, but at least you can claw that back on taxes and at least have that go against your earnings. So that's going to be the benefit to a margin and cash account over a TFSA or an RRSP. I hope this is sort of making sense. But essentially, for tax purposes, you would want to do TFSA or RRSP. However, if you want to go a little bit more riskier, you can go margin or cash. However, here's an advantage again. So myself, I have held a couple of stocks that have gone up massively in my TFSA. For example, my initial investment in Tesla, it tripled before I sold it. At least a few of the shares. I sold a few shares at one point, but it tripled. The shares that I had, I think I ended up with 8 shares that I just held on to long term in my TFSA, and they tripled before I sold them. Well, that money that I tripled, which ended up being around $9,000, was tax free. If I was to do that in a margin account, I would be taxed on those $9,000. So that's also the other thing about it, where you could take a risky investment in the TFSA and understand that, hey, it's going to hit my long-term contribution ability towards that account if I take a loss. But at the same time, if I make $100,000 on a TFSA, that's tax-free $100,000. So it depends on how risky you want to be. I used to do a lot of risky stuff in the TFSA. Remember, you cannot day trade in the TFSA, but on a margin account, you can day trade if you wanted to. So that is kind of the balancing point between the accounts. I hope this has sort of made sense. I hope I haven't confused anybody. If I have, of course, comment below. I'll see you guys again in my next video. I hope that you have enjoyed.